today we are very honored to have Mohnish Pabrai with us. He managed multi-billion dollar hedge fund, and the growth rate of the Pabrai investment funds grew in the market every year. The SP 500 growth rate is about 7%, and the annualized gain of Mohnish Pabrai's fund is more than 12%. So Mohnish has been featured by Wall Street Journal, Forbes, CNN, PBS, CNBC, Bloomberg TV, all over. So if you just Google his name, you will see all those news articles talking about his success in the investment world. So Mohnish and I, we met at the Berkshire Hathaway meeting. And since then, we had this connection, and Mohnish is very generous, giving us seminars at CBA in the past years, and we continue doing this. So today he's giving us a guest lecture. So Mohnish has given a guest lecture in Columbia, Boston University, Cambridge, all the prestigious universities. So we are very lucky to have Mohnish here with us today. So so let's give a welcome to Mohnish. Yeah, thank you.
Thank you, Professor Liu. It's a pleasure. It's always fun to be in your class, and also to the live session in May in Omaha is always wonderful as well. So shall we get started?
Let's get started. Yeah.
Okay. All right. We can go to the next slide. So, Charlie Munger, he passed away last year, and he was a director of Costco for many decades. And Charlie truly loved Costco. And I used to meet Charlie for dinner at his place maybe 3-4 times a year. And I used to play bridge with him sometimes on Fridays, the LA Country Club. And almost every time I met him for dinner, at least 20-30 minutes was on Costco. He always had a number of things to say about Costco and different nuances. Charlie referred to Costco as the ultimate win-win-win business model. So it is a business that does an exceptionally good job for all its customers. It is a business that does a very good job for its shareholders. It is a business that does a really good job for its employees. It's a business that does a very good job for its vendors. Just the entire ecosystem benefits. And like, for example, there are many business models which you could call as win-lose. So, for example, there's a company that stretches out the payments they have to make to their suppliers. Maybe they take 60 days or 90 days, pay their suppliers, and they use that float to improve their financials. Well, that works well for the company, but not so well for the supplier, right? So that's kind of an example of a win-lose business model. So Munger always brought up how Costco was amazingly win-win across the board. In fact, there's a quote by him recently, I think 2022 was saying that just imagine how good a country the US would be if everybody followed the Costco model. And even if you look at something like employee compensation at Costco, there are a lot of hourly workers. It's a retail operation. Costco's hourly rates are 50% more than Walmart, for example. Their employee turnover is much lower than all other retailers. They heavily promote from within. In fact, the present CEO of Costco started as a forklift operator, and he moved all the way up to now CEO of this large company. So it's definitely a win-win for the employees. If you go to the food court in Costco, you can get a hot dog and a Coke or a soda for $1.50. And that $1.50 price has not changed in several decades. And, we've had a lot of inflation last few years and beyond. They've kept that price the same. I mean, you can have a full meal at Costco for under $2. You can't do that even at McDonald's. They've always tried to keep prices low. They do not mark things up more than 15%. That's the maximum markup they have. And Costco could raise prices by 5% or more tomorrow across the board, and their profits would go up and their sales would not change, at least not in the short term. But they don't do that because they're not really a retailer. They're like a buying agent. So Charlie always loved the Costco model. These win-win business models are very rare. And these win-win business models tend to do extremely well for investors. So one of the things to look for when you're looking at different businesses is try to look at Is it win-win? Is it win-lose? And this whole notion of win-win, win-lose is very complicated. It appears to be simple, but it is not. Let's go to the next slide. At the 2005 Berkshire Hathaway annual meeting, there was a question someone asked. I'm not going to go through the whole answer, but Warren had answered part of the question. And then Charlie said, yeah, I think he's asking in part, are there some businesses we won't have as subsidiaries in Berkshire, even though they are wonderful businesses? So are we rejecting some businesses, some business opportunities on moral grounds? And Warren Buffett says, yeah, well, we've referred in past meetings to one we did on that basis. We will own stocks of companies where we wouldn't want to own the whole business. I'm not sure that the logic is perfect on that, but we would not have trouble owning stock in a cigarette company. We wouldn't want to manufacture cigarettes, We might own a retail company that sells cigarettes. I mean, there are all kinds of gradations. But there are things we do not want to own and be responsible for their businesses where we have no problem owning their stocks or bonds. And some years back, Charlie and I went down to Memphis, and let's go to the next slide. And then Buffett says, yeah, we were invited down and we looked at a company that made a product that perfectly legal, probably one of the best businesses I've ever seen in terms of the economics of it. And then Charlie Munger says, absolutely. And then Buffett says, still doing well. We went to a hotel. We met in the room with the people that had the business. And the people were perfectly decent people. And they described the business to us. And we went down in the lobby. And I remember we sat down in the lobby and just decided that we did not want to be in that business. And the lines are not perfect on this sort of thing. I mean, I'm sure there may be ads in the Buffalo News that are selling some investment advice or something that I would cringe at if I knew the people involved or what they were selling. Next slide. If you own a big retail establishment, a retailer, general merchandise, you're probably going to be selling cigarettes when you don't think you should smoke yourself or that your children should smoke. And they're not perfect. But we have turned down some, the most dramatic being that one, because took us a trip of 1,000 miles or so to finally face up to the fact that we didn't want to own it. Charlie, you have anything to add on it? So Charlie says, no, but that was interesting because, we were poor, we were young and poor, then by modern standards. And, we're very human. And we could see it was just like putting $100 million in a bushel basket and setting it on fire as we walked away. Next slide.
So Charlie, you said in your almanac, this is one of the best deals you've ever encountered, the one that you closed with a snuff manufacturer.
Yeah.
Can you go a little bit more in detail in that? And we're both
that was Conwood. It's an addictive product. People are totally hooked. They're the number 2 person in the market. They all believed in their product. Every damn one of them chewed tobacco. And the figures were just unbelievable. There was virtually no financial issue. No, nothing but money. And the cancers caused by that mouth tobacco is maybe 5% of the cancer you get from cigarettes. But it's not still. You definitely are going to kill people with that product and have no reason to die. It's the best deal we ever saw. We couldn't lose money doing it. And we passed. Fade in, fade out. Jay Pritzker, who was then head of the trustees or something at the University of Chicago Medical School. Pritzkers are big in Chicago. He just snapped it up so fast. The Pritzkers made $2 or $3 billion out of that. But do we miss the $2 or $3 billion we would easily have had? Not an iota. If we had a moment's regret, not an iota. We are way better off not making a killing out of a product we knew going in was a killing product. Why should we do that? On the other hand, if it was just a marketable security, we wouldn't feel that the morality of it was ours. But it's going to be our subsidiary. And we're going to be paying the people that are advertising on tobacco. That's just too much for us. We're not going to do it.
Basically, like he was saying that the company that they passed on was Conwood chewing tobacco. And the odds of getting cancer by chewing tobacco versus smoking cigarettes is like 1/20th. It's 5% of the odds of getting cancer by smoking cigarettes. So it's much lower than cigarettes, but it's not zero. And they passed on the business. And let's go to the next slide. These are the salient financial numbers for Conwood. So the Conwood deal came to Buffett and Munger in 1986. And you see the numbers for 1985. Those were the numbers that they were looking at. It was offered to them for $400 million. And you can see that the operating profit in 85 was around 22% pre-tax. And then, if you fast forward to 2005 or so, which is about 20 years after they passed on the deal, you can see that sales had gone up. They had a little bit more than doubled, but profits had gone up a lot more. They had gone up like more than 5x. The pre-tax margin on the business was around 55%. It was much better than even what it was 20 years before that. And the net profit, net operating margin was 36%. The Pritzkers bought the business for $400 million in 86. Like Charlie said, Jay Pritzker snapped it up so fast because it was just so easy to see this was going to just mint money. And the Pritzkers sold it 20 years later for $3.5 billion. So they had, close to a 9x or something, 8 or 9x. And the business kept going after that. If you go another 10 years forward to 2016, you can see that sales have doubled. Profits have gone up even higher than sales. And so now the after-tax margin is almost 40%. I mean, this is an unbelievable business. And like we see over here, Munger said in 86, when they saw this, it was the most no-brainer business that they were looking at. And he said, we could see it was just like putting 100 million in a bushel basket and setting it on fire as we walked away. And then Buffett had said, probably one of the best businesses I've ever seen in terms of the economics of it. So in 1980, the stock price of Berkshire Hathaway was around $400 a share. Okay, what is now about, close to $700,000 a share was almost 1/200th of that price in 1980. In 1986, I'm guessing the price may have been somewhere between 1,000 and 2,000 per share, around there. And the market cap of Berkshire, which is now hovering around $1 trillion, would have been around, well under $1 billion. Maybe 500 million or so. So this particular deal was a very meaningful deal for them, in terms of if they had done this deal, it would have been a very sizable part of Berkshire Hathaway at that time. And it would have driven some incredible results for them, but they took a pass on it. Let's go to the next slide. So I already told you that basically kept compounding, and let's go to the next slide. So this is Valeant Pharmaceuticals. Some of you may be familiar with Valeant, or maybe you were too young when Valeant was imploding about 8 or 9 years ago. But Valeant was a darling of a lot of investors till around the middle of 2015, and then it began a very precipitous decline. Let's go to the next slide. In June 2015, Sequoia Fund, Ruin Cunniff Goldfarb, which was actually a fund that actually started in Omaha. It was the fund that Buffett's original partners in the Buffett partnership were recommended by Warren to invest in when he was shutting down his partnership in 1970. So in many ways, Warren says he feels like he's the father of the Sequoia Fund or Ruin Cunniff. Anyway, Ruin Cunniff at that time, in the middle of 2015, had more than 1/3 of its portfolio in Valeant. So about $7.5 billion in Valeant out of a $21 billion portfolio. Bill Ackman's Pershing Square had about 30% in Valeant, so about more than $4 billion out of a $14 billion portfolio. And some of you might know Jeff Ubben at Value Act Capital. He had about $3.3 billion in Valeant out of a $20 billion portfolio. All three of them suffered huge declines and huge losses when Valeant imploded. Buffett was really upset at the whole Valeant saga, at the way Ruin Cunniff invested in it, made it its largest position. As we will see, it was not a win-win business model. So Charlie Munger called Valiant's core strategy, and he said this before the decline in the stock price. He called Valiant's core strategy of buying smaller drug companies and then raising prices deeply immoral. He said sewer was too light a word for Valiant. And Buffett and Munger made these comments while Valiant was still flying high and deeply loved by Ackman, Ubben, and Ruane Cunniff. Let's go to the next slide. Actually, let's go back to the previous slide. Basically, what was the problem with Valiant? So there was a guy who was the CEO of Valiant, who was a former consultant at McKinsey. And he had an insight that basically pharmaceutical companies had a lot of inefficiency in the way they spent money on R&D. So he had analyzed and found that a lot of pharma companies really do not kind of do a holistic analysis of how efficient or effective their R&D is. So he came up with a business model where Valiant would acquire smaller drug companies. It would gut their R&D departments, basically almost wipe them out. And they would look at the portfolio of all drugs that the company was selling, and they would increase the hell out of the prices on those drugs. So many of these drugs were under patent. Many of these were life-saving drugs that really didn't bother them. They basically raised prices to as high as they could get away with. And of course, when you do the combination of those two things, the earnings go up a lot. And then they were basically running almost like what Warren called a chain letter, where they would continuously buy these drug companies, continuously gut their R&Ds, continuously raise prices dramatically, and just kept going. And Bill Ackman is a really smart investor. I'm going to talk about some investors here. I'm not trying to beat up on them. I respect a lot of these investors, but I'm just telling you how easy it is for our brains to miss something obvious. So these are really smart investors. Ruane Cunniff is a very good shop. Pershing Square is a very good shop. Value Act Capital is a very good shop. They missed something very basic. What they missed was that the business model was win-lose. And a lot of investors don't pay enough attention to the win-lose nature of business model. It's really important to do that. When you run businesses through that lens, you can say no very quickly to a lot of businesses without spending a lot of time on them. Let's go to the next slide. So Credit Acceptance is a company that makes auto loans. And they make auto loans to people who have the worst possible credit. So these are people who have repeatedly not paid back their loans in the past, people who have defaulted on their credit cards, who have had maybe foreclosures on their homes. They have never been responsible about credit. They are the people they lend to, but they have a very unusual business model. So what Credit Acceptance does is, because they are lending to people with extremely low FICO scores and very high risk of default, the interest rates are extremely high, 30%, 40%, 50% interest rate. The second thing that they do is that the car dealership that is selling the car is made to have skin in the game. So let's say, for example, there's a car being sold for $10,000. And let's say, for example, that the car dealer is going to make $2,000 on that sale. Their cost of the car is like $8,000. They're going to sell it for $10,000. And let's say that Credit Acceptance is going to finance $9,000 of that car loan. What they will do is they will tell the car dealership to finance $3,000. Okay, so $3,000 is coming from the car dealership and $6,000 is coming from Credit Acceptance. And the borrower gets $9,000 at a very high interest rate. Now they do this so that the car dealer, who's the one who's meeting the borrower, is making some assessment of whether this is going to work or not. Because if it doesn't work, the car dealer is going to be upside down. They had a $2,000 profit, but they've put $3,000 into the deal. So they would be upside down if the loan doesn't get paid. When the car is financed, there is a device put in the car in most of the deals where once the payment is 24 hours delayed from where it's, so let's say it's due on April 15th and it's April 16th and Credit Acceptance has not received a payment, the car will not start. So they will remotely disable the car from starting. So the person goes to get in the car, it doesn't start. And then they call credit acceptance, and credit acceptance says, we haven't got your payment. Please send your payment. Your car will start again. Okay. So this is the way. And after about maybe 4 or 5 days or a week of no payment being received, one day the person will go outside and see there's no car. It's been repossessed. So they have a very good ecosystem of repossessions and non-starting cars. One of the interesting things about car financing is people are more willing to default on their mortgages versus car payments. The reason is that if you default on your mortgage, it's going to take 12 to 18 months for the bank to get you out of your house. But if you default on your car payment, even if it's not credit acceptance, even if it's Chase or somebody, they will start working on repossessing your car in a few weeks. So you won't be able to go to work. Whereas if you don't pay your mortgage, you can still go to work every day. So generally speaking, auto financing is a pretty good place to be because of these nuances. Now, let's go to the next slide. As you can see from the previous slide, credit acceptance has not imploded like the way Valeant imploded. It's doing fine. It's actually extremely well regarded by investors. And if you look at the previous slide, they've delivered incredible returns to the shareholders. And the present and past shareholders of credit acceptance include Ruane Cunniff, Seth Klarman, Francois Rochon. He comes to Omaha every year, runs a great fund from Montreal. Rob Vinal in Europe, and Francis Chu and Maverick Capital and so on. Now, I had studied credit acceptance a few years back, and I was really impressed by their business model. I said, wow, this is a really good business. This company is helping people who would not have the ability to get a car. And while I was studying the business and I was kind of interested and excited about it, I had a dinner with Charlie. And I brought up at the dinner with Charlie, this must have been like, maybe 3-4 years back. And I said, Charlie, have you heard of a company called Credit Acceptance? He said, no. So I said, let me describe the business to you. And I must have spent less than a minute talking to Charlie about credit acceptance, explaining the business exactly the way I explained it to you. And he interrupted me. He said, we're not interested in that kind of business. And that was really surprising to me. So I asked him, he said, we don't want to do predatory lending. We don't want win-lose business models. So, it was interesting to me because till I spoke to Charlie, it had never really dawned on me that credit acceptance was a win-lose model. To me, it seemed like they were helping a demographic that would not have wheels, would not have a car, and helping them becoming responsible. But Charlie's kind of standards are, we can make a lot of money by taking the high road. So he immediately rejected credit acceptance. When he brought up the win-lose nature to me, I immediately stopped looking at credit acceptance. Thank God for Munger as a friend. I didn't make that investment. Okay. But of course, a number of these people that I have on this list still have an investment in credit acceptance and they love it. They talk in glowing terms about it. Let's go to the next slide. So TransDigm, if you look at this company, it's up 173x in the last 18 years, 33% annualized. Unbelievable. And let's go to the next slide. So you can just see that their revenues have gone up a lot. The earnings have gone up a lot. And let's go to the next slide. These are the present and past shareholders of TransDigm. Wally Weitz is based in Omaha. Some of you might know Wally Weitz. He's on the Berkshire board. He runs the Weitz mutual funds. Chuck Akery, Maverick Capital, Steve Mandel, Daniel Loeb, Brian Lawrence, David Abrams, a very good set of investors have either currently or in the past owned TransDigm, right? And then let's go to the next slide. And in one of his last public comments before he died, this is probably maybe 8 to 12 weeks before Charlie Munger passed away, he was asked about TransDigm in a podcast, his last podcast. And he said, I don't like that way of making money. It's too brutal. they figured out something that has a little monopoly due to the Defense Department regulations, and they raised the price 10 times. And they're famous for it. I regard that as immoral. So, what is the TransDigm business model? TransDigm is in the aerospace parts manufacturing business. What they do is they buy these smaller aerospace parts manufacturers. Now, if you have something like the Boeing 737 airplane, for example, almost none of those parts are made by Boeing. Boeing is basically an assembler, right? So the fuselage comes from Spirit Aerosystems and all the different pieces, the engines come from GE, etc. So, and it takes a lot to get a part qualified and approved by the FAA to go into an airplane. This is why air travel is so safe. And typically these parts that go into the Boeing 737 or Airbus, etc., do not have more than a couple of manufacturers. Sometimes they might just be one manufacturer of a particular part, and they may never be more than two or three, because it's not that you manufacture the part, you have to have that part approved by the FAA. And the FAA is not going to approve a part unless they're 5,000% sure about the quality and nature of the manufacturer and all of that. So what TransDigm does is when they buy these companies, they dramatically jack up the price a lot, and to whatever the market will bear. And the market can bear a lot because there are not 10 different manufacturers you can go to for that part. So Munger immediately saw that as win-lose, right? And he was very familiar with TransDigm. He's very familiar with the money they're making. And basically, Berkshire's never made an investment in it. And there are people on Berkshire's board, like Wally Weitz, for example, who have had these investments. And like, if you look at that list of investors, it's a who's who list. So these win-lose type scenarios are not easy to figure out all the time. Sometimes it's obvious, but many times it's not. I mean, you can look at a cigarette company and say, yeah, this doesn't work. Or you can look at a casino and say it's win-lose, etc. But sometimes you get to models like TransDigm, which appear to be great. So I thought a lot to myself about how does Charlie do it? Or how did he do it? And how was he so fast? Because I saw his brain, it blew my mind to watch his brain in action on credit acceptance, a company he's never heard of. And in less than 60 seconds, he's dismissed it. And I realized that the model that he's using is the model of inversion. So Charlie always said, invert, always invert. A lot of problems can be solved by using inversion. And so the question he asks himself anytime he encounters any investment is not, why should I make this investment? He's looking for the flimsiest reason to take a pass. So his mind is immediately running on, why is this a bad investment? Not, why is this a good investment? And when he keeps hammering on it and cannot come up with a reason, like Costco, then he falls in love with the investment. And then actually those win-win investments will end up having such tremendous returns for investors because of the extreme loyalties and goodwill. So if you think of a customer of TransDigm, a customer of TransDigm or a customer of Valeant is a pissed off customer. They are being forced into a corner and they're forced to pay a high price. A customer of credit acceptance, even if he's a deadbeat, thinks the 50% interest rate he's paying is gouging, even though he's defaulted on every loan he's taken in the past. And so in capitalism, because there's 50,000 stocks, we can be extremely selective. We can say no to almost everything. And Warren's biggest complaint with Charlie was he was what he called the abominable no man, okay? Like Warren knew that anytime I call Charlie, he's going to tell me how stupid I am and how bad the idea Okay, so Warren knew even before he called Charlie that almost anything is going to bring to Charlie's attention, Charlie is going to reject. Okay. And I remember, for example, that when they bought Genry, which was the largest acquisition Berkshire had done, I think they did the deal in what, 96 or 97 or somewhere around then. And Genry turned out to be a huge problem investment for Berkshire. They had to work very hard because the culture had eroded and they had not realized that, and they had paid a big price for it. So Munger was asked about the Genry investment. It was a $20 billion acquisition for Berkshire at the time. I think the market cap was only like 60, 70 billion at the time, maybe less. And he said, oh, I didn't know about this deal until it was almost done. So it's interesting. A $20 billion deal is not brought to the board of Berkshire. It's not brought to the lifetime partner of Warren Buffett. Warren looks at the deal and proceeds on his own. And probably one of the reasons he didn't bring it up to Charlie is because he got probably sick and tired of the no's and said, oh, this one, I know insurance, I'm going to go do this. So Charlie's huge value to Berkshire. I wish we had a list of every investment that Warren wanted to make and Charlie said no. That would be a great list to look at because it went through one great mind and then the second great mind stopped it. And it's because of the second great mind, I think, is why Berkshire has the record it has, is because so many of the deals that Warren would have done didn't happen. So these are just some thoughts I wanted to share with you guys in terms of win-lose. So when you look at investments, I think it's a very good filter to always begin with in your head with what is wrong with this? Why won't this work? Why should I not make the investment? Thank you.
Yeah, thank you, Mohnish. So now it's time to ask questions. So I know many of you guys are interested in finance, investment, and we have an expert here. And yeah, so you can ask anything related to the lecture, or anything about, investment in general, or anything otherwise. Yeah, it's a great opportunity.
Do you think anyone could replace Charlie Munger?
There was and always will be just one Charlie Munger. So I was, I have to pinch myself. I got to see Charlie up close and personal. But we don't need to see him up close and personal. I think that if you look at the body of work that Charlie has put together, I think that we have not had a mind like that amongst humans in at least 2,000 years. And we are unlikely to see a mind like that. So I think Charlie is one of a kind. In my last meeting with Charlie, which was exactly 1 month before he passed away, I never I think my friendship with Charlie was about 13, 14 years. In 13 or 14 years, I never asked him to meet me because I always felt like he's got a lot of demands on his time and I don't want to be making requests, etc. So whenever I met for bridge or dinner or whatever, it was on Munger's initiative, right? So he's the one who said, let's meet or whatever. In the summer of 2023, I felt like I wanted to meet Charlie. So for the first time ever, I actually approached his assistant and said, can you please see if Mr. Munger is available for dinner sometime and I'd like to meet him. And he immediately said yes. And I met him. And it turned out that dinner was exactly 30 days before he died. And I didn't know at the time that would be the last time I would see him or that would be the last. And it was just me and him. There were just two of us for that dinner. And his mind was still really sharp and everything. And I asked him a question. He's got 8 kids and he's got, infinite grandkids and many great grandkids. And I said, Charlie, in your gene pool, who stands out? And his answer to me was no one. Okay, so I said, what do you mean, Charlie? I know so many of your kids and grandkids, they've gone to all these elite schools and they've done so well. He said, oh yeah, he's saying they're smart, they've done well in school and they've done well in life and all of that. But they're not, he said, I know the question you're asking, Mohnish, and they are not at that level. So there was no one there, right? And that was his gene pool. But I say that my view is that you go outside the gene pool to 8 billion humans. that are currently alive, and there's no one like Charlie. And I think if you go back 2,000 years in history, there's no one like Charlie. So, people draw analogies with Ben Franklin. I think Ben Franklin's one of a kind. I mean, I think he's very unusual. And Charlie has a lot of common traits with Ben Franklin. But there are things about Charlie that were not part of Ben Franklin. Many things about Ben Franklin are not part of Charlie. So I think that the amazing thing about Charlie is that there's an incredible body of work he left for us. So we have Poor Charlie's Almanack. We have all the Berkshire meetings, which are archived on buffett.cnbc.com. We have all the daily journal transcripts and all of that. So we have a lot of resources and things that Munger said available to us. And I think that studying those can only help us become better. Like today's talk was a very small, less than 1/10 of 1% of Charlie, which is this whole idea of win-lose and, why should I not make the investment, right? So it's a small part of what he does. But yeah, I don't think there's no other Charlie Munger, and I don't think we'll ever see one.
One day when there's no Warren Buffett, do you think that Berkshire is going to be the same company with the same values, or is it going to be something different?
So it's a different skill set to keep Berkshire going than what was required to create it. The creation of Apple needed Steve Jobs, but Tim Cook couldn't have created Apple. But he's proven to be a great leader in managing and running Apple. And so the skill set needed at Berkshire to take it forward from here is not the skill set that Warren and Charlie had led to the creation of Berkshire. So keeping it going is a lot simpler than the creation. Now, having said that, the big challenge with Berkshire Hathaway is size. And its size is a problem even if Warren and Charlie lived forever. So it's not so much a successor issue. It's an issue that would be an issue no matter who's running it. So I think Greg Abel will be a very good leader. I think he's a very capable guy, very smart, and I think he understands the Berkshire culture. And Berkshire has got a lot of tailwinds going for it. It has a great reputation. And so if we have a crisis, which, humans have a good record of creating crises every 10, 15 years or so. If we have a crisis, Berkshire will shine. It's got a lot of liquidity and it can go on the offense and such. So I think the Berkshire of the future has a good future.
Say you're 19 years old and you don't have what you have now and you're doing it all over again. How would you start?
Should I assume you're 19?
Good guess.
Okay. Well, it's a very big advantage to be 19. Warren always says that when he's asked this kind of question, that he would happily trade places with you. He would give you everything he had, make you 94 years old. And then he would be 19 and go from there. So he would be happy to trade places with you. I think that if you, at 19, if you have a very good understanding, so it depends what your objectives in life are. If your objective in life is to compound assets and be successful and be wealthy and so on, it's a relatively simple game if you just do a few things. And one of the most important things is you're already asking me the question when you're too old. So I wish you asked me this question when you were 7 years old, because we lost 12 years, man. We lost 12 years that we cannot bring back. But it's better than asking me this question when you're 30 years old. So it's not too bad. 19 is not a bad age. One of the things to keep in mind is that the laws for individual retirement accounts, IRAs, are that you could be 6 months old and you can have an IRA. There's no minimum age to have an IRA. The requirement is that the money that you put into an IRA has to be wages earned by you. Okay, so for example, if you were 15 years old and you did some odd jobs and worked at a McDonald's, whatever, and you made, let's say, $10,000 in a year, for example, you could put 5,000 or 6,000 of that. I don't know what the exact number is. I think it's 6,500 into an individual retirement account. You could put up to 100% of those earnings into an individual retirement account, and they would be tax sheltered. They would not be taxed until they're withdrawn. And if you did in a Roth IRA, they're taxed upfront but never taxed later. So Having fluency in the US tax code is important. Being able to compound money in a tax-free manner is important. So when my daughter was 19, actually she was 18, when my daughter was 18, she just finished high school and she got a summer job and she made, I think, $5,000 or $6,000 that summer. And she was living at home and didn't have any expenses, etc. So the 5,000, 6,000 was just sitting there, basically it wasn't used. And I had told her, listen, if you want to take my advice, I would just put this money into an IRA. And if you trust me, you can give me power of attorney and I can manage that. So she did that. She opened an IRA. And one time she went to school at NYU, and one time we were living in California then, and I used to pick her up at 2 or 3 in the morning at LAX when she'd come home. And so one time we had a long drive, like more than an hour. It was like 2 or 3 in the morning and we were driving back. So I said, this is a good time to talk about the power of compounding with her. And so I said, look, that $5,000 you put in your IRA. So let's say, for example, because I'm only going to put it in 1 or 2 stocks, concentrate the hell out of it. Let's say it grows at 15% a year. So I asked her, what would that amount be when she turned 68, which was 50 years from now? So if you know the rule of 72, which you can Google if you don't know that, 72 divided by 15 is 5. Basically, 15% compounded will double every 5 years. 5,000 is going to become 10,000 in 5 years. It's going to become 20,000 in 10 years, 40,000 in 15 years, so on. 50 years is 10 5-year periods. That's 2 to the power of 10. 2 to the power of 10 is 1,024. Let's throw away the 24 because I like easy math. So 5,000 times 1,000 is 5 million. So the 5,000 that she made at 18, at the age of 68, 15% annualized compounded is $5 million. And then I told her at 19, you might do another internship. You might make a little bit more money, but let's say you save another 5,000. At 69, that's going to be another $5 million. And at some point, you're going to graduate, I told her, 22 or something, and you'll make maybe 100,000 a year. And you might save 10, 20,000. And you might be able to put that away because you can now do a 401k and an IRA and so on. So I asked her, and by now she's wide awake. She was falling asleep, but she's wide awake. So I said, you keep doing this, and after 10, 15 years, your income might be $250,000 or something, and it keeps going and you keep saving. So how much money do you have when you're 70? And she said, I don't know, it's too big a number. There weren't a lot of heroics required to do that. Now, you can take that 15% compounding rate down to even 8 or 9%. And even then, the number will be very large. The key is, from the age of 19, I cannot do anything about what happened in the past in life because you never came and talked to me when you were 7. It's terrible, but that's okay. Okay, but at least we've talked today. So from here on out, you can stop making the mistakes you made in the past. And so spend less than you earn, always. Put the money to the max if you can in a retirement account and let it compound. One of Munger's best quotes is, do not interrupt compounding unnecessarily. So we're not going to go on vacation or, empty the 401k or empty the IRA or go to Hawaii or something or buy a fancy car and all of that. We're going to live a happy life, and a happy life doesn't need a lot of money. And like, for example, once a week, my partner and I have dinner at Costco. Okay. Both of us have hot dogs. The drinks are free. And I might sometimes get a slice of pizza. It's like $6. It's a great date night. And I get to spend an hour in the most orgasmic place on, Costco. I just watch the swarms of humanity so happy with their loaded carts as they leave Costco. It's a great date, and the price is right. And then the next night we go for dinner at some fancy place. It's like $200 and it wasn't even as good. So I'd say just do all your dates at Costco. Then that means you met the right person. And basically you keep compounding and you're done. You live a good life, you put some away, and then you wake up one day, you look to your left and look to your right, and those people who are your peers, they're way back from where you are. And you can't even see them from where you are. And that's it.
How do you feel about Blackstone investment firm?
Blackstone is a wonderful company. Steve Schwarzman built a tremendous company. The sovereign wealth funds have huge amounts of money to put to work, and they have very few places where they can give that money to be put to work. So they are like 3 or 4 toll bridges, like Blackstone and Apollo and Brookfield. And the Abu Dhabi Investment Authority or the Qatar Sovereign Wealth Fund or Singapore's Wealth Fund, these are the places they have to give the money to. And they've been really good at how they've deployed at scale. So I think it's a very good business. If you think of it from a win-win, win-lose point of view, lose part of it possibly could be leverage. Leverage is always a negative, but almost all their leverage is non-recourse, and they're usually quite prudent about the way they do that. So yeah, it's a good business serving a demographic that needs their product. Sure.
And you want to start. So Mohnish Mohnish, when did you start your first investment?
I didn't know a lot about investing. I accidentally read a book about Warren Buffett when I was about 30 years old, and the light bulb went off. So, at 19, you have a huge head start. I didn't know what investing or stocks or compounding or anything else was till I was 30. So 1994 was when I first started to invest.
Yeah, tell us more about your story. I think the students are very interested, how did you become so successful, even you started late? What's the secret? What's the recipe?
Well, the thing is that for all of us in different fields or different interests that we are going to sometimes have an aha moment. And the important thing when you have that aha moment is to seize the moment and to go all in. So one of the things that I realized when I was reading Warren Buffett, one of his biographies of Warren Buffett, when I was 30, and the big aha moment that hit me was that Buffett has a quote. He says, "I'm a better investor because I'm a businessman. And I'm a better businessman because I'm an investor." There's an interplay between running a business and being a good investor. And what I realized when I was looking at the way he was doing different investments is that I had been an entrepreneur since my mid-20s, 24, 25. And I was spending maybe 3 or 4% of my time figuring out the strategy and direction of the business I had. And then about 95, 96% of the time on the blocking and tackling to actually execute on that strategy. So most of the time went on, executing on it. What I realized when I read about Buffett is that he was using the same part of the brain I was using to figure out my strategy for my business, to figure out his investments. And except that it was 80% of his time and not 3 or 4% like I was. So because he was not running something, he had a lot of time available to invest. And I always found the 4% time on strategy to be a lot more interesting than the 96% herding cats and making things happen. I mean, it was fun, but the 4% was the most fun, figuring out what's going to be a strategy, what's going to be a direction, all of that. And I realized that if I spent more time as an investor, that 4% time would increase. And I was very interested in that. So in 94, when I was 30, I had about $1 million. I just sold a portion of my company, and after tax, I had 1 million. So I said, okay, I'm going to start studying these public companies, and I'm going to try to figure out which ones are likely to do well in the future. And that whole notion of trying to figure out what these companies were all about and how they're likely to do in the future was very similar to trying to figure it out for my own company. Like I said, it's using the same part of the brain. And that's why Buffett said, I'm a better businessman because I'm an investor and so on. So when I started to invest, I found my life is a lot happier and more exciting because now that 4% time was increasing, I was spending about maybe 10, 15, 20 hours a week doing investment research. And that was really exciting for me. And I got to the point about 5 years later when I pretty much lost interest in the company I was running. So the $1 million that I had at that time in 94, had done really well. I had compounded at more than like 70% a year. It was sitting at about 13 or 14 million. It had done extremely well. I was at 35, I was independently wealthy outside of the business I had. And so it enabled me to make a choice where I said, I'm not going to run my business anymore. So I basically started a search for a CEO so that I would leave my business and I could spend all my time on that 80% like Buffett was spending. So the genesis of all that was that when I read the Buffett biography, there was an aha moment. And these aha moments can come to us in all kinds of different fields and areas. It can come in sports, it can come in whatever, you have aptitude for. But the important thing is, I think that you've got to take the bull by the horns at that point. So you can't just say, oh, that's interesting, and kind of move on. You've got to really go for it at that point when you've got these aha moments. So basically that's what I would recommend and suggest.
Do you have any books you recommend or anything to start understanding that stuff better?
Well, the one book which I'm sorry to say would be of more value than 4 years at UNO would be Poor Charlie's Almanack. If you were to spend about $25 buying Poor Charlie's Almanack, it's slightly cheaper than the 4 years at UNO, with, I think, maybe more take-home value other than Professor Liu's class. And the back half of the book has about 11 talks that Charlie Munger has given over the years. Those are priceless. Those have thousands of years of human wisdom in them. And one of the talks, the 25 causes of human misjudgment, psychology of human misjudgment. I mean, I think I try to reread that talk every year. That talk really does a great job explaining how humans are wired. And it's a huge advantage in life if you understand, especially the wiring defects of humans. Our brains are not rational creations. Our brains are a result of a very messy, long history of evolution. And there's ancestral parts of our brain, and there's newer parts of the brain, and it's a mishmash of a lot of different things. And there's a lot of distortions from reality caused in our brains. And that's one of the reasons. So, for example, we see all these great investors who invested in Valeant, right? Why did that happen? Well, that's partly the result of this crazy wiring the brain has. It's not a, perfect rational creation. It's got weirdness. And so understanding that weirdness can be a big advantage.
So I have one last question. So you give killing some advice, for those 19 and 18 years old students, what can they do? So what other advice would you give them, like at this stage of life, like in life in general, not just investment?
Yeah, one of the things Buffett talks about, he says that if we hang out with people better than us, we become better. If we hang out with people worse than us, we become worse. That should be pretty obvious when you think about it. Issue that we run into as humans is we have friendships. And sometimes we may have friends who aren't great humans. And they may even pull us down. One of the important things in life, which is difficult to do, is to be a harsh grader with your friends. So you have to increase interactions and friendships with the people who are better than you. And you have to let go some of the ones that aren't quite there. And, a lot of people are loyal. And this flies in the face of loyalty. So if your mental model is loyalty over all else, then you may be hurting yourself long term. So again, I think in life, what happens is that we have choices. And many times these choices require us to take what sometimes might be difficult or unpleasant actions. And those difficult and unpleasant actions may not be natural and may even be, one might say, inhumane or, cold-hearted, if you will. But I think that those are really important things to keep in mind. When I became friends with Charlie, I started to meet his friends. And when I met his friends, I was blown away. The quality level of these people was truly off the charts. And I know that what may have happened, which I didn't see in the decades before I met Charlie, was that he probably went through a pruning process where he increased interaction with some folks and decreased interaction with other folks. So one of the easy decisions I made was I tried to make friends with Charlie's friends. Now, a lot of them are old and some have passed away and so on. But that actually was extremely wonderful because these people were just so off the charts. And that same thing has been true in many ways when I come to Omaha. Every May when I come to Omaha, I've been coming to Omaha every May since 1997. So it's like more than a quarter century. And so many deep friendships have come out of Omaha. And when I look at the folks I met in Omaha, who are now part of my close friends, they're off the charts. So, for example, the average Berkshire Hathaway shareholder is an above average person. He or she is not the same as the general population. And that universe of people in Omaha is kind of self-selected and self-filtered to give you a certain kind of person. And in the case of Charlie's friends, that was an extreme version of that. So I think that being a harsh grader and being very deliberate about who your close friends are has a huge impact long term.
Thank you so much, Mohnish.